All right, we need to talk about something big that's unfolding right now. A potential $10 trillion panic, all starting with an election in Japan. And look, this isn't some distant theoretical problem. The panic is already spreading. You've got Germany breaking its own borrowing rules. And get this, borrowing costs in the UK are now even higher than during the crisis that toppled a prime minister. We're talking about three of the world's biggest economies, all spiraling at the exact same time.
So what's with this number? 236%. Well, that is Japan's government debt as a percentage of its entire economy. Let me just say that again, 236%. That is, by far, the highest debt-to-GDP ratio in the entire developed world. Now, for a long time, this was kind of manageable, right? Because interest rates were basically zero. But not anymore. With rates now on the move, that giant pile of debt is starting to look like a ticking time bomb.
And that brings us to the big question, the one that really matters to you. How on earth can a number in Japan actually raise your mortgage rate right here in America? I know it sounds a little abstract, but trust me, there is a very real, very direct line from the chaos in Tokyo to the interest you pay on, well, everything. Your car, your credit card, your house. So let's connect those dots, because this isn't some forecast for next year. It's happening now.
To really get a handle on this global threat, we've got to go back to the beginning. We have to start where it all kicked off, Japan. You know, for decades, it felt like Japan was defying economic gravity. But gravity always wins in the end. And right now, Japan is looking like the first massive domino that's starting to wobble.
And just to put this into perspective, I mean, look at this. Japan's debt, at 236%, isn't just a little bit higher than everyone else's. No way. It's nearly double the US level. It makes the debt in the UK and Germany look tiny by comparison. Japan is just in a completely different league here, a league of its own when it comes to borrowing. So you might be asking, how did things get so bad so fast? Well, it was just this rapid-fire series of events. First, the central bank hiked interest rates. Okay. Then, the prime minister comes out and announces this huge spending package with, get this, no plan to pay for it. And on top of that, he calls a surprise election promising even more spending. The market's reaction? It was immediate and it was brutal. Borrowing costs just shot through the roof to record highs, and boom, you've got a perfect storm of financial and political chaos.
Okay, so Japan has a huge problem on its hands. We've established that. But why does it matter to you, right? Why should you care? Well, this is where it gets scary. This is where something called financial contagion kicks in. It's how a local crisis can suddenly turn into a global wildfire.
And here is the absolute key to the whole thing, the American connection. Japan is the biggest foreign owner of U.S. debt. We're talking $1.2 trillion. That gives them a ton of influence over our interest rates. It's exactly why the U.S. Treasury Secretary was scrambling to get on the phone with Japan when this all started to blow up. He knows that if Japan gets into real trouble and has to start selling those bonds to raise cash, it's going to send massive shockwaves right through our markets.
But wait, there's another threat, and this one might be even bigger. It's called the yen carry trade. For decades, it was basically the easiest trade in the world. Big investors would borrow money in Japan for almost nothing and invest it all over the globe, especially in U.S. stocks and bonds. The size of this thing? An estimated $20 trillion. Now, as Japan's interest rates finally start to go up, that whole trade just stops working. Investors have to unwind it. And unwind just means they have to sell all those U.S. assets to pay back their loans in Japan. Imagine that. $20 trillion of selling pressure hitting the market. That is a terrifying thought.
And this is how it plays out. You can literally see the chain reaction, the dominoes falling one by one. It starts in Japan. They sell U.S. bonds. That massive sale causes U.S. borrowing costs to spike. Then, Europe is forced to raise their rates just to keep up, which completely wrecks their national budgets. And the end result? The final domino? Spending cuts, higher taxes, and a global recession. All because high borrowing costs choke off the economy for everyone. It's just a vicious, interconnected cycle.
Now, I know what you might be thinking. Okay, that sounds like a scary theory. But here's the thing. It is not a theory. The contagion is already happening. Let's shift gears and look at Europe for a second. Because Germany and the UK, they are already showing some really serious signs of a debt crisis of their own.
This is just incredible. Germany, the country that has spent years lecturing the rest of Europe about being responsible with their money. Well, guess what? They're now breaking their own constitutional law on debt. Seriously, the rule is written right into their constitution. It says their deficit can't be more than 0.35% of their economy. And the reality, it's on track to be 4%. That's more than 10 times the legal limit. The teacher of austerity has become the biggest spender in the class.
And it's not just Germany. Hop across the channel to the UK, and the mood is just as dark. Look at this headline. This isn't from some random blog, okay? This is from one of Britain's most respected economic think tanks, and they're openly asking if a shock in their bond market, they call it the gilt market, could literally derail the entire economy. When the serious buttoned-up institutions start putting out red alerts like this, you really got to pay attention.
And if you want proof that the crisis is already here, just look at this chart. Remember the whole Liz Truss government fiasco back in 2022? It collapsed in what, 49 days? At the very peak of that chaos, UK borrowing costs hit 5.1%. Now, look at where they are today, 5.64%. Think about that for a second. The market is more panicked about UK debt right now than it was during a crisis that literally brought down an entire government.
So, we've seen the fires starting in Japan. We've seen the embers landing in Europe. Now we get to the most important part of all. What does this whole global mess actually mean for you, for your wallet, your 401k, and your financial future?
You know, what makes this whole situation so tricky is the uncertainty. It's like for every action, there could be two opposite reactions. For example, if Japan starts dumping its US bonds, yeah, your mortgage rate is probably going to spike. But if a full-blown global panic kicks in, investors might flood into US bonds, looking for a safe haven, which could actually push rates down. See what I mean? Your international stocks, they could get crushed. But US stocks might actually do better as people seek safety. The big takeaway here is just extreme volatility. The old rules might not work anymore, and that makes being prepared more important than ever.
All right, understanding the problem, that's step one. We've done that. Now, step two is taking action. And listen, this isn't about running around in a panic. This is about being smart. It's about preparing. So let's walk through a simple, actionable playbook that you can think about to help fortify your finances.
First up, let's talk about your portfolio. With all the risks we're seeing in Japan, Germany, and the UK, it might be prudent to think about reducing your exposure to international stocks. And with your bonds, maybe diversify a bit away from just long-term ones. Their value gets hit the hardest when interest rates climb, which makes them super risky right now. And maybe the most important thing, keep some cash on the sidelines, what investors call dry powder. In a crisis, believe me, cash is king. It gives you safety and it gives you the flexibility to jump on opportunities when everyone else is forced to sell.
Okay, next up, your debt. This is really a time to play defense. If you've got any variable rate debt, credit card balances, a home equity line of credit, that kind of thing, it's probably a good idea to look into refinancing that into a fixed rate. You really want to get rid of the risk that your monthly payments could suddenly skyrocket. And of course, this isn't personal financial advice, so talking to a professional who knows your specific situation is always the smartest play.
So here's the bottom line. The whole point of this explainer isn't to scare you, it's to prepare you. That's the goal. These big, systemic crises, they don't just happen overnight. They tend to build up over months, and that gives you time. The people who get really hurt in these situations are the ones who get caught completely by surprise. But the people who stay informed, who understand the risks, and who prepare calmly, they're the ones who can protect themselves and even find opportunities in the chaos.
If you look at the history of these kinds of debt crises, they all teach you the same lesson. They always seem impossible, right up until the moment they become inevitable. And all the data we're looking at shows that the dominoes in Japan, in Germany, and in the UK are already wobbling. So at this point, the real question isn't if something is going to break, it's what breaks first. So the question I'll leave you with is, will you be ready when the inevitable arrives?